During the 2008 financial crisis, cash holdings by major corporations skyrocketed by over 300% in just 6 months. This wasn't panic. It was a calculated response to what economists call speculative demand for money. And it's the same force affecting your wallet right now. While everyone else was frantically buying and selling, those who understood this hidden economic principle quietly positioned themselves for maximum advantage. Today, I'm exposing this secret psychology of money that explains why sometimes holding cash isn't just safe. It's strategically brilliant. The hidden game your money plays. Have you ever noticed how sometimes your money seems to have a mind of its own? Like when you're itching to invest, but something holds you back. That feeling isn't just random hesitation. It's actually your brain playing an economic game you didn't even know you signed up for. Money isn't just a piece of paper or numbers on a screen. It's more like a living entity with its own psychological rulebook. Think about the last time you had some extra cash sitting in your account. Maybe the rational part of your brain was saying, "Hey, we should invest this." But something else, something deeper, was telling you to hold on to it. That voice saying, "Wait," isn't just caution. It's actually a sophisticated economic mechanism at work in your brain. Let me introduce you to Sarah. Sarah has $10,000 sitting in her savings account earning practically nothing. Every morning, she checks the stock market. Every evening, she reads financial news. She knows she should invest, but something keeps stopping her. "I'm just waiting for the right time," she tells herself. But that right time never seems to come. This isn't Sarah being indecisive. She's actually playing a complex psychological game with her money, one that millions of people play every day without realizing it. The fascinating thing? Economists have been studying this behavior for decades, and they've given it a name. What's happening is that Sarah, and probably you too, is making financial decisions based on invisible psychological forces that operate behind the scenes of your conscious mind. These forces are so subtle that most people never recognize them, yet they drive some of our biggest financial choices. Your money is basically playing chess while you think you're playing checkers. It's making moves based on economic conditions that your brain is processing subconsciously. Interest rates go up, your money plays defense. Stock market looks wobbly, your money retreats to safety. New investment opportunity appears promising, your money cautiously advances. And here's the wild part, this isn't random behavior. When economists look at large populations, they can actually predict these patterns with startling accuracy. Your individual financial decisions, which feel completely personal and unique to you, actually follow predictable trends that economists have been tracking since the 1930s. Think about a time when you had cash but hesitated to invest it. Maybe it was during market volatility, or when interest rates were changing, or when economic news was unsettling. That hesitation wasn't just you being careful. It was your brain calculating complex economic equations without you even realizing it. The average person makes dozens of these calculations daily, weighing factors like opportunity cost, risk assessment, and potential returns, all unconsciously. Your brain is essentially running economic simulations in the background while you're just trying to decide whether to keep cash in your account or put it somewhere else. What's more fascinating is that your money psychology doesn't just affect small decisions. It shapes entire life trajectories. The difference between someone who builds wealth and someone who doesn't often comes down to how they navigate these invisible psychological forces. Let's look at Tom and Jessica, who both earn similar salaries. Tom constantly gives in to the psychological pull to keep his money in cash, waiting for the perfect moment to invest. Jessica understands this pull, but has created systems to counteract it, automatically investing regardless of what her psychology is telling her. Fast forward 20 years, and their financial situations look dramatically different. Not because of their income, but because of how they responded to these hidden psychological forces. Think about your own financial behavior. Have you ever found yourself refreshing stock prices multiple times a day during market volatility? Or maybe you felt a strange relief when you decided not to invest, even though logically you know investing is how wealth is built. These aren't random feelings. They're manifestations of the economic game your mind is playing. The rich and powerful have understood this game for centuries. Warren Buffett famously said to be fearful when others are greedy and greedy when others are fearful. He's directly addressing this psychological force that drives most people's financial decisions. He's recognized the game and learned to play it better than almost anyone. Imagine if you could see these invisible forces that are guiding your decisions. What if you could recognize when your brain is playing this game and make conscious choices instead of being pulled along unconsciously? The difference in your financial future could be staggering. The truth is that money actually does have a psychology that affects your financial decisions. Economists call this speculative demand. The tendency to hold on to cash not because you need it for daily expenses or emergencies, but because you're unconsciously speculating about future opportunities and risks. When you hold extra cash just in case, or because the market doesn't feel right, you're experiencing speculative demand in action. It's your brain calculating complex economic variables and producing a feeling rather than a rational thought. That feeling then drives your decision to hold cash instead of investing it. This isn't some minor economic concept. It's a fundamental force that shapes everything from individual retirement accounts to global financial markets. Trillions of dollars move around the world based on this psychological principle, yet most people never even know it exists. Understanding this hidden game can transform your relationship with money. It can help you recognize when you're making decisions based on psychological forces rather than rational analysis. It can reveal why you sometimes feel an almost magnetic pull towards certain financial choices, even when they don't make logical sense. The most successful investors and financial minds have learned to recognize when this speculative psychology is influencing their decisions. They've developed strategies to either overcome it or use it to their advantage. And the good news is you can too. Think about how many financial decisions you've made in your life. How many of them were truly rational, and how many were driven by these invisible psychological forces. Once you start seeing the pattern, you can't unsee it, and that awareness alone can dramatically improve your financial outcomes. The birth of speculative demand, Keynes' big discovery. What if I told you that one of the biggest economic discoveries of the 20th century happened because of a stock market crash? While most of us struggle to recognize these hidden financial patterns, a British economist spotted them almost a century ago during complete economic chaos. Ever wonder why your grandparents who lived through the Great Depression kept cash hidden around the house instead of in banks or investments? The answer wasn't just trauma. It was an economic principle that explains why you still hesitate to invest today. Meet John Maynard Keynes, not just any economist, but the guy who completely flipped traditional economic theory on its head during the 1930s. Picture this. The stock market has crashed, unemployment is skyrocketing, and the entire global economy is in free fall. Most economists at the time were scratching their heads, clinging to their classical theories that markets would eventually self-correct. But Keynes noticed something weird that nobody else was paying attention to. People were hoarding cash like crazy, and not just for buying groceries or paying bills. They weren't even saving it for emergencies. Nope, they were holding on to money for an entirely different reason that classical economics couldn't explain. Even when decent investment opportunities existed, people clutched their dollars tightly, refusing to let go. This behavior made absolutely no sense according to the economic theories of the time. If people were rational, they'd put their money to work in investments that could grow their wealth. But Keynes realized humans aren't always the logical calculating machines that economic models assumed. He saw that fear and uncertainty were driving people to keep cash on hand, just in case better opportunities came along later. That's when Keynes had his light bulb moment. He identified a third reason people hold money that nobody had recognized before. People already knew about the transaction motive, keeping cash for daily spending, and the precautionary motive, emergency funds. But Keynes discovered the speculative motive, holding cash because you're essentially betting on better investment opportunities in the future. Think of your money like a patient hunter, crouched in the tall grass, watching and waiting for the perfect moment to pounce on its prey. That's speculative demand in action. It's not just sitting idle, it's actively waiting for the right opportunity. Sometimes that opportunity is a stock market dip, a real estate crash, or interest rates changing. Your money might look lazy sitting in your account, but psychologically, it's on high alert. Keynes didn't just notice this pattern, he built an entire economic framework around it in his book, The General Theory of Employment, Interest, and Money. His revolutionary idea challenged everything economists thought they knew about how money worked. Keynes himself put it perfectly when he said, "The difficulty lies not so much in developing new ideas as in escaping from old ones." This was mind-blowing because traditional economists believed markets would always self-correct through individual actions. If investments were attractive enough, people would naturally put their money there. But Keynes showed that during tough economic times, pessimism could create a self-fulfilling prophecy. People hoarding cash meant less investment, which meant fewer jobs, which meant even more reason to hoard cash. Keynes reshaped our understanding of money itself. It wasn't just a medium of exchange. It was also a store of value that people managed based on their expectations of what might happen next. This completely transformed how governments approach economic policy during downturns. Instead of letting the economy heal itself, which could take forever, Keynes argued that governments should step in to break the cycle of pessimism. But here's where it gets personal for you. This same psychological force is still at work in your bank account right now. Ever found yourself putting off investing because it doesn't feel like the right time? That's your brain playing the speculation game Keynes identified. You're unconsciously waiting, hunting for better opportunities, convinced they must be just around the corner. The really wild part? Most of us have no idea we're doing this. We come up with all sorts of logical-sounding reasons why we're waiting to invest. The market seems overvalued. I'm waiting for a pullback. Interest rates might change soon. But beneath these rationalizations is the same psychological force that Keynes spotted during the Great Depression: speculative demand. This explains why you sometimes hold on to cash, even when it makes no mathematical sense. The interest you're earning in your savings account might be practically nothing compared to potential investment returns, but your brain is convinced it's smart to wait. You're not being irrational. You're unconsciously speculating that better opportunities will come along if you just wait a little longer. Understanding this hidden force is like putting on a pair of financial X-ray glasses. Suddenly you can see what's really driving your decisions. Not just the logical reasons you tell yourself, but the deeper psychological motivations Keynes uncovered. This awareness alone can transform how you approach your finances. Next time you find yourself hesitating to invest, ask yourself, am I making a rational choice based on facts, or am I unconsciously playing the speculation game? Sometimes waiting is indeed the right move, but often it's just this psychological force working behind the scenes, costing you potential returns while you wait for the perfect moment that might never come. The interest rate seesaw. Why your money plays hard to get that psychological speculation game isn't just happening in your head. It's responding to a powerful signal that's constantly changing right under your nose. What most people don't realize is that the Federal Reserve, through a single number they control, is secretly influencing your money decisions more profoundly than you'd ever imagine. When interest rates shift, they don't just make headlines, they literally rewire your financial psychology. Think about the last time you hesitated to move money from your savings account into investments. Was it really your decision, or was your money playing hard to get? Here's what's actually happening. Your cash is performing an intricate dance choreographed by interest rates, and you're just along for the ride. When interest rates are low, your money gets antsy. It's like that friend who can't sit still at a boring party, constantly looking for something more exciting to do. With bank accounts paying practically nothing, your cash practically begs you to send it somewhere with better prospects. This isn't just a feeling, it's economic science in action. But flip the script and watch what happens when interest rates climb. Suddenly your money transforms into that cautious friend who'd rather stay home than venture out. It's playing hard to get. When you can earn decent interest without any risk, that cash gets comfortable right where it is. Why risk investing in stocks or real estate when your money can grow safely in a high-yield account? This invisible push-pull effect is behind so many of your financial decisions, even when you don't recognize it. The math behind this relationship is surprisingly straightforward. As interest rates rise, the opportunity cost of holding cash decreases. In plain English, when rates are high, you're giving up less potential return by keeping money in cash form. Let me show you how this works in the real world. When interest rates hover around 1%, parking $10,000 in a savings account means you'll earn about $100 a year. Pretty disappointing, right? That same money invested in the stock market might return $700 or more. Your brain quickly calculates that $600 difference and starts nudging you toward investing. But when interest rates jump to 5%, that same $10,000 now earns $500 just sitting in your account. The gap between safe returns and risky returns narrows substantially. The voice in your head saying, Just wait a bit longer, gets louder, and that's speculative demand in full swing. The Federal Reserve knows exactly how this psychological game works. It's not just controlling some abstract economic levers. It's literally programming your financial behavior. When they want people to spend and invest more, they slash rates, making cash feel practically worthless just sitting around. When they need to cool down an overheating economy, they hike rates, making cash suddenly seem sexy again. This pattern shows up in investment data too. Historically, when the Fed cuts interest rates, the S&P 500 posts positive returns 86% of the time within the following year. That's not coincidence. It's your brain's reward system responding exactly as designed. Lower rates make holding cash feel painful, so you seek returns elsewhere. The fascinating part is how this affects everyday decisions beyond investing. When rates rise, your entire relationship with money shifts. Shopping for that new car? Higher interest rates mean more expensive loans, which makes you think twice. Planning home renovations? Same story. The opportunity cost ripples through your entire financial life, changing not just where you put your money, but how you think about spending it. Companies play this game too, but on a massive scale. When rates are high, corporations hoard cash on their balance sheets, sometimes billions of dollars worth. When rates drop, they suddenly announce aggressive expansion plans, stock buybacks, and increased dividends. It's the same psychology, just with more zeros involved. But here's where it gets really interesting. Your brain isn't perfectly rational about this relationship. Sometimes you'll hold cash even when interest rates are rock bottom, or invest aggressively when rates are climbing. Why? Because opportunity cost is just one factor in your financial psychology. Fear, greed, and uncertainty can override the math. The scary part is that most financial advisors rarely acknowledge this invisible force. They'll talk about risk tolerance and time horizons, but few will discuss how your behavior predictably changes as interest rates fluctuate. Understanding this relationship gives you a superpower in financial decision-making. You can see this seesaw effect most clearly during dramatic rate changes. When rates plummeted after the 2008 financial crisis, many investors who initially hoarded cash eventually capitulated and poured money into stocks, driving one of history's longest bull markets. Their cash, earning essentially nothing, finally became too painful to hold. Conversely, as rates rise, the Tina effect, there is no alternative to stocks, weakens. Cash and bonds start to look attractive again. The investment opportunities need to be significantly better to overcome that guaranteed return. Your money gets pickier about where it goes. The most powerful insight here isn't just understanding that this relationship exists. It's recognizing when it's actively influencing you. Next time interest rates change significantly, watch your own behavior. Do you suddenly feel different about your cash holdings? That's not random. It's this psychological seesaw at work. This mathematical relationship creates an inverse correlation between interest rates and investment behavior. Higher rates mean less investment and more cash holding. Lower rates push money into riskier assets. The Federal Reserve uses this to essentially program mass financial behavior, like a puppeteer controlling millions of strings simultaneously. What's wild is that most people have no idea this psychological game is even happening. They attribute their changing attitudes about money to their own brilliant insight or caution, never recognizing that their behavior. 2008, when money played its biggest game. While most people remained oblivious to this financial manipulation game, 2008 delivered a masterclass in what happens when money psychology goes haywire. That year, when Lehman Brothers collapsed, we witnessed the transformation of rational financial calculation into pure primal fear. Remember all those invisible economic forces we've been talking about? In 2008, they stopped being invisible. They exploded right into everyone's face like a financial volcano that had been building pressure for years. The entire global financial system wasn't just wobbling, it was on the verge of complete collapse. What happened next was fascinating from a psychological perspective, but terrifying if you were living through it. Companies that normally invested their capital suddenly started hoarding cash like squirrels preparing for the longest winter ever. But this wasn't just normal caution. This was panic on a scale economists hadn't seen since the Great Depression. Take Apple as a perfect example. By the end of 2008, they were sitting on a mountain of cash, $24.5 billion to be exact. That was up from $18.5 billion just a year earlier. Think about that. In the middle of the worst financial crisis in generations, Apple increased its cash reserves by $6 billion instead of investing it in growth, development, or literally anything else. And Apple wasn't alone. Across corporate America, companies were stockpiling cash at unprecedented rates. Why? Because when fear takes over, the speculative demand for money goes through the roof. The psychological calculation changes from where can I get the best return to how can I make sure I survive. The Federal Reserve saw this panic unfolding and responded with dramatic action. They slashed interest rates, cutting and cutting until they reached nearly zero by December 2008. Based on everything we've learned about money psychology, this should have pushed all that hoarded cash back into investments. Lower interest rates should make holding cash less attractive, right? But something fascinating happened instead, something that completely defied the mathematical logic we've discussed. Despite interest rates plummeting to virtually nothing, speculative demand for cash actually increased. Companies continued hoarding money even though it was earning basically zero interest. This created a mind-blowing paradox that perfectly illustrates money psychology. Holding cash when interest rates are near zero is mathematically illogical. You're essentially choosing to make nothing when you could be investing in something that might grow. Yet fear and uncertainty became so powerful that they overrode the normal interest rate mechanism. As retired banker Bob McGovern put it during this period, "Until then, I'm just going to keep it in cash. I like the safety." This simple statement captures the essence of what was happening across the entire economy. Safety trumped opportunity. Fear trumped greed. Psychology trumped mathematics. What's particularly fascinating is that this behavior wasn't rational from a strictly numerical perspective. When interest rates drop to near zero, the opportunity cost of holding cash becomes enormous. You're essentially giving up free money by not investing. But during the crisis, that didn't matter. The psychological need for security became so powerful that it completely rewired how people made financial decisions. This is where we see the true power of what Keynes discovered decades earlier. Speculative demand isn't just some academic concept. It's a primal force that can bring the entire global economy to its knees when it shifts into panic mode. But here's where it gets really interesting. While most people and companies were paralyzed by fear, those who truly understood the psychology of money saw an incredible opportunity. They recognized that this extreme fear was creating massive discounts in asset prices that didn't reflect the true long-term value. These financial strategists knew that when the pendulum of speculative demand swings too far in one direction, it eventually has to swing back. They understood that the psychological forces driving everyone to hoard cash would eventually subside, and when that happened, all that money would come flooding back into investments, driving prices up. So while everyone else was selling in panic or sitting frozen with their cash, these strategic investors were buying quality assets at fire sale prices. They weren't immune to fear, they felt it too, but they recognized it as a psychological reaction rather than a rational assessment of value. The most successful investors during this period weren't the ones with the best mathematical models or the most sophisticated analysis tools. They were the ones who understood money psychology and could see beyond the panic of the moment. They recognized that when speculative demand reaches extreme levels in either direction, it creates opportunities. For those who can keep their psychological bearings. This is particularly striking when you consider that the fundamentals of many businesses hadn't actually changed. Yes, there were serious economic challenges, but many healthy companies saw their stock prices plummet not because their business model was broken, but because fear had temporarily replaced rational valuation. The 2008 crisis demonstrates something profound. Money has a psychology that can operate completely independently from mathematical logic. When faced with extreme uncertainty, humans don't behave like calculating machines. They behave like humans, with all the fear, irrationality, and instinct for self-preservation that entails. The financial crisis proved that Keynes was right all along. The speculative demand for money isn't just one factor among many. It can become the dominant force driving the entire economy when fear takes over. When uncertainty peaks, people and companies will hoard cash even when it makes absolutely no mathematical sense to do so. The risk paradox, why low rates push you toward danger. But Keynes nailed it about fear driving us to hoard cash. There's an equally powerful evil twin waiting in the wings. When interest rates drop near zero, something bizarre happens to your financial brain. Suddenly, the safest place for your money becomes the most dangerous decision you could make. Think about it this way. When banks offer virtually nothing for keeping your cash safe, your money starts getting restless, impatient, even a little reckless. It's like that friend who gets bored at a quiet party and starts suggesting increasingly wild activities. Let's try crypto. How about that tech startup? I heard house flipping is easy money. This psychological flip side is what economists call the search for yield phenomenon. When traditional safe investments like savings accounts or government bonds yield practically nothing, people don't just sit there accepting their 0.1% returns. Instead, they venture into increasingly risky territory hunting for better returns. And here's the crazy part. The Federal Reserve knows this and intentionally uses it. When they slash interest rates to near zero, like they did from 2008 to 2015, and again from 2020 to 2022, they're not just trying to make borrowing cheaper. They're playing with your money psychology, practically shoving you toward riskier investments to stimulate the economy. During these low-rate periods, just watch what happens. Money doesn't just sit still. It flows like water, finding the path of least resistance, rushing toward anything promising a decent return. Between 2008 and 2015, investors who once considered stocks too volatile suddenly became stock market enthusiasts. Real estate that previously seemed speculative started looking like a safe bet. The money wasn't just moving, it was sprinting away from cash. This isn't just some theoretical concept. You can see it everywhere when rates hit rock bottom. Your cousin who never invested before suddenly can't stop talking about his Tesla stock. Your neighbor who always played it safe is now flipping houses on the weekend. Your uncle is sending you cryptocurrency memes at 2 a.m. It's like the entire world decides to become financial daredevils at the exact same time. The 2020 to 2022 period provides the perfect case study. Interest rates crashed to near zero, and what happened? An absolute explosion in speculative investments. Cryptocurrencies went from niche internet money to dinner table conversation. Companies with no profits but great stories saw their stock prices skyrocket. People were trading meme stocks based on Reddit forums. This wasn't just normal investing. This was speculative demand operating in complete reverse. Remember how Keynes described people hoarding cash during uncertainty? This is the mirror image. When cash itself becomes uncertain, because inflation might eat it alive while it earns nothing, people abandon it en masse. But here's where it gets dangerous, especially for new investors who've never experienced the full market cycle. This flood of money into risky assets creates bubbles. Prices detach from fundamental values. A Morgan Stanley report during this period noted that the expectation of continued low rates had triggered a surge in speculative investments, with analysts warning about potential market corrections. What's particularly cruel about this whole game is that the inexperienced investors, often the last ones to join the party, typically suffer the most when the music stops. They buy at peak prices, driven by the stories of easy money and overnight millionaires, only to experience devastating losses when reality reasserts itself. This is the dark side of speculative demand. Instead of being too afraid to invest, people become too afraid not to invest. The fear of missing out replaces the fear of losing money. The psychological pendulum swings completely in the opposite direction. But it's still being driven by the same underlying mechanism, our emotional relationship with uncertainty. What's fascinating is how this creates a predictable pattern. When interest rates stay super low for extended periods, you can almost set your watch by the sequence. First, money flows to blue-chip stocks and real estate, then to high-yield bonds and emerging markets, and finally to the most speculative assets like unproven tech stocks, cryptocurrencies, and collectibles. It's like watching a psychological tide gradually push people into deeper and more dangerous waters. The Federal Reserve's interest rate policies directly influence this behavior. When they cut rates, they're essentially decreasing the value of safety and increasing the appeal of risk. The stock market's performance during these rate-cutting cycles tells the story. Markets typically rally as investors flee the newly unattractive bond and cash positions. During the COVID-19 pandemic, this effect went into overdrive. Stuck at home with stimulus checks, trading apps, and endless time to watch YouTube investment gurus, many new investors jumped into the market with both feet. The results were predictable: extraordinary market volatility, asset bubbles, and eventually, painful corrections. The speculative demand concept Keynes identified works both ways, like a psychological seesaw. When rates are high and uncertainty looms, cash becomes king. When rates are low and cash offers nothing, speculation becomes king. But in both cases, it's the same underlying force driving behavior, just pointed in opposite directions. Here's the ultimate irony. The very tool designed to create financial stability, lowering interest rates during economic distress, ends up creating its own form of instability through excessively risky behavior. By solving one problem, central banks inevitably create another. It's like taking medicine for a headache only to develop stomach problems as a side effect. So what's the practical takeaway here? Understanding this psychological flip side gives you a massive advantage. When you see everyone around you suddenly becoming investment daredevils during periods of rock-bottom interest rates, recognize it for what it is. Not investing wisdom suddenly descending upon the masses, but a predictable psychological response to monetary policy. The 3 signs you're under money's spell right now. That advantage I just mentioned? It starts with recognizing when you're under money's spell yourself. The real power comes when you can spot the signs of speculative demand in your own financial behavior. And trust me, most of us are experiencing it right now without even realizing it. Let's get personal for a minute. Have you ever found yourself constantly refreshing financial websites before making a simple investment decision? Or maybe you've been sitting on a pile of cash for months, telling yourself you're waiting for the right moment to invest? These aren't just random habits. They're telltale signs that speculative demand is pulling your financial strings. The wild thing is, most people experience these exact behaviors, but completely misinterpret what's happening. We tell ourselves we're being prudent or doing research, when in reality, we're caught in money's psychological game. So let's break down the 3 dead giveaways that speculative demand has hijacked your financial brain. Sign number 1. You're obsessively checking interest rates or market conditions before making even basic investment moves. This behavior is classic speculative thinking in action. You tell yourself you're gathering information, but what you're really doing is looking for that perfect moment to jump in, which never seems to arrive. If you've ever found yourself saying, "I just need to check the rates one more time before I decide," you're not making a rational financial decision. You've fallen into the speculative trap of waiting for the right moment that psychology tells you must exist somewhere in the future. This constant checking creates a false sense of control while actually leading to decision paralysis. You feel like you're being thorough, but you're really just stuck in a loop of uncertainty, unable to act because the perfect conditions never materialize. Sign number 2. You've got a significant chunk of money sitting idle while you wait for the right time to invest it. This is perhaps the most obvious sign of speculative demand at work. That cash sitting in your low-yield savings account isn't there because it's part of your emergency fund or because you have an upcoming expense. It's there because deep down, you believe better investment opportunities are coming in the future. The problem? This waiting game often leads to missed opportunities in the present. While you're sitting on the sidelines, thinking you're being smart by avoiding potential losses, you might actually be losing out on significant gains. This behavior is especially revealing when interest rates are low and your cash is essentially earning nothing, yet you still can't bring yourself to put it to work. Sign number 3. You feel a wave of anxiety about investing whenever interest rates start rising. This is your brain's speculative demand circuit lighting up like a Christmas tree. When rates rise, a part of your brain starts screaming that cash is becoming more valuable just sitting in the bank. This creates a genuine emotional response, actual anxiety about putting your money into investments when it could be safely earning interest. This anxiety isn't random. It's a direct psychological response to changing market conditions. Your brain is calculating opportunity costs without you even realizing it, creating emotional resistance to investment decisions that might have seemed obvious just months earlier. What makes these signs so sneaky is how easily we rationalize them. We don't think, "I'm experiencing speculative demand today." Instead, we tell ourselves stories. "I'm just being careful with my money," or "I need to do more research," or "now's not the right time." The psychological factors driving these behaviors run deep. Fear, greed, and even peer pressure heavily influence our financial choices. That gut-wrenching fear of missing out when everyone's talking about their amazing investment returns, that's pushing you towards speculative behavior. The scarcity mindset that makes you hoard cash, just in case. That's speculative demand in a different costume. Financial literacy experts emphasize that understanding these psychological barriers is crucial to effective money management. Concepts like opportunity cost and risk tolerance aren't just economic jargon. They're tools to help you recognize when your brain is playing tricks on you. Here's what makes this awareness so powerful. Most people go their entire lives never recognizing these patterns in themselves. They bounce from one emotional financial decision to another without understanding the invisible forces guiding their choices. But you now have the ability to see through the illusion. Think about your own financial situation right now. Are you holding on to cash without a clear purpose? Feeling weirdly reluctant to invest even though you have the means? Obsessively tracking interest rate news? If you answered yes to any of these questions, congratulations, you've caught speculative demand in the act. The good news is that awareness itself is incredibly powerful. Simply recognizing when these psychological forces are at work gives you the opportunity to pause and ask yourself, is this a rational financial decision, or am I just responding to speculative demand? This doesn't mean you should ignore these feelings entirely. Sometimes that hesitation serves a purpose. The key is distinguishing between genuine financial caution and unconscious psychological responses to changing market conditions. These behaviors aren't character flaws. They're hardwired human responses that even the most sophisticated investors experience. The difference is that successful investors have learned to flipping the script, using money psychology to your advantage. Those sophisticated investors aren't just recognizing these patterns. They're actually weaponizing psychology to make money while everyone else is frozen by indecision. Ever wonder why some people seem completely unfazed by market swings while you're checking your banking app 20 times a day? The difference isn't their knowledge of finance. It's their mastery of the psychological hacks that virtually eliminate speculative demand's control over their decisions. Here's what most financial advisors never tell you. Understanding the psychology behind your money decisions gives you a superpower. While they're busy talking about diversification and risk tolerance, important stuff, don't get me wrong. They completely miss the mental game happening in your brain every time interest rates shift. Think about it. Most investment advice treats you like a perfectly rational decision maker who weighs all options logically. But we now know that's not how humans operate, especially when it comes to money. Your brain is literally wired to play the speculation game, whether you want to or not. So how do we flip this script and turn money's psychological tricks back on itself? I've studied the habits of investors who seem immune to these mental traps, and they all use a similar framework, a set of psychological circuit breakers that prevent speculative demand from hijacking their decisions. Let's break down the 3 strategies that form this framework. Strategy number 1, set firm investment rules before interest rates change. This is absolute gold. The most successful investors aren't constantly reacting to the market. They're following pre-established rules that bypass their psychological urges completely. Picture this. You decide today, when you're thinking clearly, that you'll invest 15% of every paycheck regardless of what interest rates or markets are doing. This simple commitment creates what psychologists call an implementation intention, a decision made in advance that doesn't require willpower in the moment. The magic happens when interest rates start climbing and your brain screams, "Hold cash." But because you've already committed to your investment rule, you simply follow through without the mental wrestling match. The psychological pull of speculation gets completely short-circuited. This proactive approach doesn't mean you can't adjust your strategy when truly necessary. It just ensures those adjustments come from rational analysis rather than psychological impulses. Your future self will thank you for making decisions when your brain isn't under the influence of speculative demand. Strategy number 2. Harness the power of dollar cost averaging to neutralize timing anxiety. This strategy is like kryptonite for speculative demand. Remember how we talked about constantly checking rates and waiting for the perfect moment to invest? Dollar cost averaging eliminates that entire mental loop. Instead of trying to time your investments perfectly, which even professional investors fail at consistently, you invest a fixed amount at regular intervals. Here's why it works psychologically. Your brain stops obsessing about finding the perfect entry point because there is no single entry point. Some of your investments will happen when prices are high, others when they're low, but over time you're capturing the average. The beauty of this approach is that it transforms speculation from your enemy into your ally. When markets drop, your regular investment actually buys more shares. And when speculative demand drives others to panic sell during downturns, you're calmly sticking to your system, potentially scoring bargains. What's fascinating is how this simple mechanical approach completely sidesteps the psychological traps we've discussed. You're not fighting your brain's speculative tendencies. You're simply creating a system that makes them irrelevant. Strategy number 3. Create purpose-based money buckets that clarify what's actually available for speculation. This might be the most powerful psychological hack of all. Most people keep their money in one or two accounts, creating constant confusion about what cash is truly available for investment. This ambiguity feeds speculative demand because your brain treats all that money as potentially waiting for better opportunities. The fix: separate your money into distinct accounts based on purpose. Emergency fund, completely off limits for investment. Short-term savings for planned expenses in the next 1 to 3 years. Investment capital, actively deployed according to your strategy. This separation creates powerful psychological boundaries. When your money has clear purposes, your brain stops playing the what-if game with funds that should never be part of that equation. The emergency bucket, for example, isn't sitting there because you're waiting for better investment opportunities. It's there for actual emergencies. This mental clarity dramatically reduces the influence of speculative demand on your overall financial picture. What's particularly interesting is how this approach reveals exactly how much money you're genuinely holding for speculative reasons. For many people, this awareness alone can be a wake-up call. Wow, I've got $40,000 just sitting there waiting for the right time to invest. These 3 strategies work together to create a psychological framework that puts you back in control. But here's the part that might shock you. The opportunity cost of not implementing these strategies could be enormous. Think about it. How much money have you kept in cash temporarily while waiting for the perfect moment to invest? For many people, this amount can reach tens or even hundreds of thousands of dollars over a lifetime. That's money that could have been growing and compounding for years. The real power comes when you combine all 3 approaches. Set your investment rules in advance. Implement them through regular dollar-cost averaging, and clearly separate your money by purpose. This comprehensive framework turns the psychological forces we've discussed from obstacles into advantages. What's really incredible is how these strategies don't require complicated financial knowledge. They don't demand perfect timing or market predictions. They simply require understanding the psychology of money and implementing systems that work with your brain rather than against it. The ultimate payoff isn't just financial, it's psychological. Imagine making investment decisions without that constant nagging doubt about timing. Imagine watching interest rates change without feeling compelled to restructure your entire financial plan. Imagine the peace of mind that comes from knowing you've protected yourself from your own psychological biases. The liquidity trap, when money psychology breaks the economy. That peace of mind from mastering your personal money psychology is incredible. But what happens when those same forces spiral out of control across an entire economy? Economists have discovered a financial nightmare they call a liquidity trap. When the psychological pull to hoard cash becomes so powerful that it can paralyze entire nations, and even central banks find themselves powerless to fix it. Think of it as speculative demand on steroids. In normal times, central banks have a reliable tool, lowering interest rates to discourage cash hoarding and stimulate investment. But during a liquidity trap, even when rates hit rock bottom at 0%, people and businesses still cling to their cash like it's the last lifeboat on a sinking ship. Japan's economy fell into this exact trap during what economists now call the lost decade of the 1990s. Despite the Bank of Japan slashing interest rates to near zero, the economy remained frozen. Nobody wanted to spend or invest, they just wanted cash. The psychological fear of losing money completely overpowered the mathematical logic that should have pushed them to invest. What makes this so fascinating is that Japan wasn't dealing with high interest rates that would normally encourage cash hoarding. They were dealing with the exact opposite. Rates so low that cash should have been flowing freely into investments. But it didn't. The psychological component of money had completely hijacked the system. We saw eerily similar patterns emerge after the 2008 financial crisis. The Federal Reserve cut rates to near zero, expecting companies and individuals to borrow, spend, and invest. But what happened instead? Massive cash hoarding. The expected increase in borrowing and spending simply didn't materialize. During this period, an eerie disconnect formed between what economic theory predicted and what actually happened. People weren't behaving according to the mathematical formulas. They were responding to fear, uncertainty, and psychological forces that no spreadsheet could capture. When central banks face this situation, they start to look like desperate parents trying every trick to get their stubborn child to eat vegetables. Since traditional interest rate cuts don't work, they resort to increasingly extreme measures. The Bank of Japan, for instance, took the extraordinary step of implementing negative interest rates in 2016. Imagine that, banks actually charging customers to keep their money safe. The idea behind negative rates is almost comical. We'll literally make your money disappear slowly if you keep it in the bank, so you might as well invest it. But even this extreme approach often falls short. Critics argue that negative rates might actually backfire, making people even more determined to find creative ways to hoard their cash rather than risk investing it. What's wild is that this macroeconomic nightmare is driven by the exact same psychological forces we've been talking about throughout this video, just operating at a massive scale. The same speculative demand that makes you hesitate to invest your $10,000 can, when multiplied across millions of people and businesses, bring an entire economy to its knees. This isn't just theoretical. It directly impacts your everyday financial life. When a liquidity trap takes hold, you'll notice strange things happening. Banks offering practically no interest, housing markets stalling, businesses reluctant to hire or expand, and stock markets becoming more volatile. The fascinating part is how liquidity traps reveal the true power of psychology in economics. For decades, economists treated people like perfectly rational calculating machines. But these traps prove that uncertainty and fear can completely override mathematical incentives. In Japan's case, an entire decade of economic potential was sacrificed on the altar of psychological fear. Understanding this concept gives you an incredible advantage in predicting how economic shifts might affect your personal finances. When uncertainty spikes, whether from a pandemic, a war, or a new economic crisis, you can anticipate the psychological wave of cash hoarding that will follow, regardless of what interest rates are doing. This insight also explains why economic recoveries often take so much longer than expected. Even after the technical end of a recession, the psychological scars remain, keeping speculative demand for cash abnormally high. This is why central banks frequently get frustrated when their policies don't produce the expected results. They're fighting against human psychology, not just economic conditions. The disconnect between monetary policy and real economic behavior during these periods is staggering. Central banks can print money, slash rates, buy assets, and still see minimal results because they're essentially trying to use math to solve a psychological problem. It's like trying to fix a relationship problem with a calculator. Expert analysis shows that individual fear can create a collective paralysis that's remarkably difficult to break. When everyone is waiting for everyone else to make the first move, the economy gets stuck in a holding pattern. Central banks find themselves pushing on a string. They can make credit available, but they can't force people to take it. What makes liquidity traps so dangerous is their self-reinforcing nature. As people hoard cash, economic activity slows, which increases uncertainty, which leads to more cash hoarding. It's a vicious cycle that can persist far longer than traditional economic theory would predict. For your personal finances, this means you need to be especially vigilant during periods of economic uncertainty. Your own natural instinct will be to hoard cash, which might be precisely when bold, counter-cyclical investment moves could be most rewarding. The greatest fortunes in history have been made by those who invested during periods of maximum fear. You'll likely experience this psychological tug-of-war during the next economic crisis. Part of you will feel an overwhelming urge to convert everything to cash, while the rational part of your brain might recognize the potential opportunity. Understanding this internal conflict ahead of time gives you the chance to prepare your response before emotion takes over. During liquidity traps, speculative demand for cash intensifies regardless of interest rates. This means you can't rely on interest rate signals alone to guide your investment timing. Instead, you need to develop a deeper understanding of fear cycles in markets and how they relate to actual economic fundamentals. The insight that connects all this is profound. Your personal financial behavior during economic uncertainty isn't just your individual response. It's part of a collective psychological pattern that can reshape entire economies. And by understanding this pattern, you can position yourself to make smarter financial decisions. The master key, balancing speculation and action. Let's flip the script on everything we've discussed. What if speculative demand isn't your enemy, but actually your secret weapon? Turns out, the wealthiest investors don't fight their psychological urges about money. They deliberately channel them through a strategy so simple you might kick yourself for not using it sooner. Financial success isn't actually about being the smartest person in the room. Morgan Housel, one of today's most respected financial writers, makes this point crystal clear. Achieving financial success depends far less on raw intelligence and far more on mastering a few basic behavioral skills. This insight completely changes how we should approach our money psychology. Think about it. We've spent this entire video talking about how your brain plays tricks on you when it comes to money decisions. But what if instead of trying to outsmart these psychological forces, you could work with them? This is where intentional speculation comes in. It's like acknowledging that yes, part of your brain is always going to want to play the market timing game, so you give it a small sandbox to play in while the rest of your money stays on track. The big revelation here is that you don't need to fight your speculative instincts. You just need to contain them. Give yourself permission to speculate with a specific portion of your portfolio. Maybe it's 5% or 10%, while keeping the rest in steady, boring investments that compound over time. It's like telling your inner financial daredevil, yes, you can have some fun, but only with this much. This balanced approach creates a psychological release valve. When you're itching to jump on the next hot investment trend, or feeling the urge to hoard cash, you have a designated portion of your money that's allowed to respond to those impulses. Meanwhile, your core wealth-building strategy stays protected from emotional decision-making. The true masters of money understand something profound that Housel emphasizes. The true value of money lies in buying freedom and options. Financial independence isn't actually about having a specific dollar amount. It's about controlling your time and having choices. When you separate your emotional speculation from rational investing, you're making this principle actionable. Let me share what this looks like in practice. Instead of having one big pool of money that's constantly pulled between fear and greed, smart investors create distinct allocations. They might have 60% in broad market index funds that they never touch regardless of market conditions, 20% in bonds or similar stable investments, 10% in cash for emergencies and opportunities, and just 10% for speculative investments they find exciting. This structure works because it acknowledges a crucial truth. Human psychology doesn't change overnight. You can't just decide to stop feeling FOMO when everyone's talking about their crypto gains. And you can't just switch off your fear when markets crash. But you can create systems that channel these emotions productively rather than letting them derail your entire financial life. Understanding your personal risk tolerance is absolutely essential for this approach to work. Some people lose sleep over a 5% market dip, while others stay calm during 20% crashes. Neither is wrong. It's about knowing yourself. Your risk tolerance directly impacts how much cash you should hold versus invest, and it changes throughout your life based on your age, goals, and financial situation. This is where Housel's insight about Warren Buffett becomes particularly relevant. He points out that Buffett's extraordinary success isn't primarily due to his genius-level intelligence, though he's certainly smart. The most important factor explaining his success is that he stuck with it. He remained invested for many decades and let the compounding do the heavy lifting. The lesson? Consistency and patience trump clever market timing every single time. The balanced approach we're talking about incorporates what financial experts call a margin of safety, building flexibility into your strategy so you can adapt to unexpected changes without abandoning your core plan. This is especially important when dealing with speculative demand forces that can shift rapidly with economic conditions. Here's where most people go wrong. They try to make all-or-nothing decisions with their money. They're either all in on the market or completely on the sidelines. They swing from extreme risk-taking to extreme conservatism based on headlines or gut feelings. This psychological pendulum is exhausting and typically leads to buying high and selling low, exactly the opposite of successful investing. The master key is creating a portfolio that reflects both your rational understanding of long-term investing principles and your emotional realities. You need an investment approach that you can actually stick with through good times and bad, not just one that looks perfect on paper. For example, if you know you're prone to panic selling during market downturns, you might intentionally hold a bit more cash than is mathematically optimal. Yes, this means slightly lower expected returns over time, but it's far better than the alternative of abandoning your investment plan entirely when things get scary. Experts recommend diversifying not just across different types of investments, but also across time horizons. Having some money allocated to short-term needs, some to medium-term goals, and some to truly long-term growth helps align your financial strategy with how your brain actually processes time and risk. What's fascinating is how this balanced approach creates a virtuous psychological cycle. When you've got your intentional speculation portion doing well, it satisfies your desire for investment wins. When it performs poorly, the limited allocation means you haven't damaged your core financial plan. Meanwhile, your steadily growing long-term investments build confidence in your overall strategy. As you implement this approach, pay special attention to the relationship between interest rates and your portfolio balance. When rates rise, you might find it makes sense to shift a bit more toward cash or bonds. When they fall, you might expand your equity allocation. But these shifts should be gradual and predetermined, not reactive emotional decisions. Another critical element is understanding that overconcentration in popular investments can be dangerous, even when they're performing well. Housel warns against this specifically, emphasizing the importance of diversifying into small cap, value, and international equities to effectively manage risk. This diversification protects you from the psychological trap of chasing whatever's currently hot. Inflation's double game, the modern twist in money psychology. Inflation might be the game changer we've been missing in our discussion about money psychology. While diversification protects your investments, have you considered what happens when the dollar itself is losing purchasing power? The current U.S. inflation rate sits at 3.3%, well above the Federal Reserve's 2% target. This isn't just a number on a financial news ticker. It's actively transforming the psychological forces driving your money decisions in ways Keynes never fully anticipated. Let's be real. When Keynes developed his theory of speculative demand, he was primarily focused on interest rates and market opportunities. But inflation adds a completely new dimension to this psychological game. It creates what I call a double bind in your financial decision-making process. Here's where things get interesting. Inflation fundamentally changes the risk calculation in your head. When prices are rising at 3.3% annually, your emergency fund isn't just sitting there patiently waiting for investment opportunities. It's actively shrinking in purchasing power every single day. That $10,000 in safe cash is guaranteed to buy you less next year than it does today. Since January 2020, inflation has eaten away a staggering 21.75% of your money's value. Think about that for a second. That means if you've been holding $50,000 in cash since the pandemic started, you've effectively lost almost $11,000 in purchasing power. Not because the market crashed or because of a bad investment, but simply because you tried to play it safe. This creates an intense psychological pressure, a ticking clock effect that completely transforms the traditional speculative demand calculation. When inflation is low, the psychological game is straightforward. Hold cash when rates are high, invest when rates are low. But high inflation flips this equation on its head. The concept of real interest rates explains why this matters so much. The real interest rate is what you're actually earning after inflation. So if your savings account pays 2%, but inflation is running at 3.3%, your real interest rate is negative 1.3%. You're literally paying to hold cash. This psychological pressure intensifies when we look at current consumer sentiment. About 65% of Americans identify inflation as their biggest financial worry right now. That fear drives behaviors that can sometimes work against our financial interests. During the 1970s inflation crisis, we saw a fascinating pattern emerge. Many investors actually increased their cash holdings despite sky-high inflation, anticipating that asset prices would decline as the economy struggled. This seemingly counterintuitive behavior makes perfect sense when viewed through the lens of heightened uncertainty and fear. The Federal Reserve's decisions on interest rates directly impact this psychological equation. When the Fed raises rates to combat inflation, it theoretically makes holding cash more attractive. But if inflation remains stubborn, even higher nominal interest rates might still result in negative real returns. Let's make this super practical with today's numbers. If you have money in a high-yield savings account earning 4.5%, but inflation is 3.3%, your real return is only 1.2%. Not terrible, but far less impressive than the headline rate suggests. Meanwhile, if you're holding cash in a regular checking account earning 0.01%, you're losing purchasing power at a rate of 3.29% annually. This creates a whole new set of psychological traps. You might be tempted to chase increasingly risky investments just to stay ahead of inflation. Or you might freeze completely, paralyzed by the fear of making a mistake while your purchasing power steadily erodes. Financial experts suggest a balanced approach during inflationary periods. Maintaining an emergency fund remains essential, but it should be paired with investments that have a chance to outpace inflation. Options like high-yield savings accounts and Treasury inflation-protected securities, TIPS, can help preserve purchasing power while ensuring liquidity. The psychological pressure of inflation explains why we sometimes see seemingly irrational market behaviors during high inflation periods. When cash is guaranteed to lose value, assets that might normally seem overpriced suddenly look reasonable as inflation hedges. This shift in perception can drive asset bubbles and market distortions that wouldn't exist in a low-inflation environment. Current inflation trends indicate this isn't just a theoretical concern. While inflation has cooled from its peak, it remains persistently above target levels. This environment encourages cautious financial behaviors that can impact everything from your retirement savings to the broader economy. So what's the payoff from understanding inflation's impact on speculative demand? It helps you avoid the psychological trap of holding too much cash during inflationary periods. Many people think they're being prudent by keeping substantial cash reserves while waiting for better opportunities, not realizing they're guaranteeing themselves negative real returns. Instead of seeing cash as the ultimate safe haven, inflation forces us to reconsider what safe really means. Is an investment truly safe if it guarantees you'll have less purchasing power in the future? Or might a diversified portfolio of assets actually represent the safer choice during inflationary times? Understanding this modern twist on money psychology helps you make more rational decisions in today's economic environment. It pushes you to consider whether you're holding cash because it truly makes financial sense, or because outdated psychological instincts are driving your choices. The most successful investors during inflationary periods are those who recognize this psychological trap. They maintain appropriate emergency reserves, but don't use inflation as an excuse to postpone investing. They understand that the guaranteed loss from inflation often outweighs the potential benefits of waiting for the perfect moment to invest. Your personal money psychology blueprint. Ever wonder why some people seem immune to financial panic, while others constantly jump between cash and investments at exactly the wrong times? Those successful investors we just talked about aren't just lucky or naturally talented. They've built personal systems that override their psychological money biases. And today, I'm going to show you exactly how to create your own money psychology blueprint that will transform your financial decisions forever. Look, without a personalized framework for making money decisions, you're basically letting your subconscious run your financial life. It's like trying to navigate a maze blindfolded. You might occasionally find the right path, but you'll hit a lot of dead ends along the way. Creating this blueprint isn't complicated, but it is powerful. Financial literacy experts have found that understanding how emotions influence your financial decisions is absolutely essential for effective money management. The good news: you can build a system that accounts for these psychological biases and helps you avoid the common pitfalls most people fall into. Let's break down the step-by-step process for creating your own money psychology blueprint. Step 1. Assess your current cash holdings and get brutally honest about why you have that amount. Grab a piece of paper or open a note on your phone. Write down exactly how much cash you currently have in checking and savings accounts. Now comes the important part. For each chunk of money, ask yourself, why am I holding this specific amount? Is it truly for emergencies? Is it because you're uncertain about the future? Or are you subconsciously waiting for some perfect investment opportunity? This assessment helps you understand the balance between cash you legitimately need for emergencies versus speculative cash that could potentially be working harder for you elsewhere. Many people discover they're holding way more cash than they actually need for emergencies, money that's slowly losing value to inflation while they wait for some mythical perfect time to invest. This honest evaluation is your first step toward breaking free from unconscious money behaviors. Step 2. Determine your true emergency fund needs. Financial experts generally recommend having 6 months of essential living expenses set aside for emergencies. Not your full lifestyle costs, just the bare minimum you'd need to survive if everything went sideways. Calculate your monthly housing costs, utilities, food, transportation, insurance, and minimum debt payments. Multiply that by 6, and you've got your emergency fund target. This money should be easily accessible, but separate from your day-to-day checking account. The key insight here is understanding that anything beyond this amount might actually be speculative cash, money you're subconsciously holding because of psychological factors rather than practical needs. By clearly defining your emergency fund, you create a mental boundary that helps you make more rational decisions with the rest of your money. Step 3. Create personal investment rules that you'll follow regardless of what the market is doing. This is where you build guardrails that protect you from your own psychological biases. Your rules might include things like, I will invest 15% of every paycheck on the day I receive it, no matter what the market is doing, or I will rebalance my portfolio every 6 months, regardless of recent performance. These rules become your financial autopilot, allowing you to make consistent decisions that aren't swayed by emotions or market noise. The beauty of personal investment rules is that they remove decision fatigue and emotional reactions from your financial life. When you have pre-established rules, you don't have to agonize over whether now is the right time to invest. You just follow your blueprint. Step 4. Establish triggers to recognize when you're making decisions based on speculative demand rather than sound strategy. These are your personal warning signs that emotions might be driving your choices. Your triggers might be thoughts like, I should wait until the market settles down before investing, or behaviors like obsessively checking your investment accounts multiple times a day. By identifying these triggers, you can catch yourself before making decisions based on fear or greed. Create a simple checklist of your personal triggers and keep it somewhere visible. When you notice yourself exhibiting these behaviors, it's a signal to step back and reconnect with your investment rules rather than acting on emotion. This awareness is absolutely crucial for maintaining a rational approach to investing. Think of these triggers as your financial smoke detectors. They alert you when things are getting too hot, so you can respond appropriately. Now here's the mind-blowing part. The potential lifetime losses from suboptimal cash allocation due to speculative demand can be staggering. When you hold excess cash instead of investing it wisely, you're not just missing out on a few dollars of interest. You're potentially sacrificing hundreds of thousands of dollars in long-term growth. Let me put this in perspective. If you're consistently keeping an extra $20,000 in cash beyond your true emergency needs, and that money could be earning just 7% in a diversified investment portfolio, you're losing out on about $1,400 per year. Over 30 years, accounting for compound growth, that adds up to nearly $150,000 in missed opportunity. But your money psychology blueprint can help you recapture those losses by ensuring your money is allocated optimally based on your actual needs rather than emotional reactions. The tools to implement this blueprint are readily available. Budgeting apps can help you track expenses and set savings goals. Financial planning worksheets can assist in calculating your true emergency fund needs. And automated investment platforms can help you stick to your investment rules without requiring constant attention. Understanding the opportunity cost of holding excess cash is a game changer. Calculate what your cash could potentially earn if invested in different assets. This simple exercise often provides the motivation needed to overcome psychological barriers to investing. Your blueprint isn't just about money. It's about freedom from financial anxiety. When you have clear guidelines for your financial decisions, you spend less time worrying about money and more time enjoying life. You're no longer at the mercy of market fluctuations or economic news because you have a personalized plan that accounts for your unique situation. The most powerful aspect of this blueprint is that it evolves with you. As your financial situation changes, you can adjust your emergency fund target, refine your investment rules, and update your trigger list. This flexibility ensures that your blueprint remains relevant throughout different life stages and economic conditions. And that brings us to the end of our journey into money's secret psychology. You've now got X-ray vision into the invisible forces guiding your financial decisions. With 65% of Americans citing inflation as their biggest financial worry, you're definitely not alone in feeling that psychological pressure when it comes to your cash. Next time you look at your bank balance, ask yourself, why am I really holding this money? Is it for everyday expenses, that emergency fund, or are you unconsciously playing the speculation game while inflation quietly eats away at your purchasing power? Remember what Morgan Housel wisely pointed out. Wealth is hidden. It is income not spent. The true financial winners aren't the market timing wizards. They're the people who understand their own psychological relationship with money and use that self-awareness to make smarter choices. With inflation projected to rise to 2.5% in 2025,